We have driven renovation spending to an all-time record high. The home renovation nightmare dream is alive and well for a lot of Canadians still. My wife and I actually think of that last blip right on that chart. I have my head self-scratching my head every time we go home at the end of the day, wondering what we were thinking on some of these projects, and I can say that because my wife's not in the room today. But this is another sign of what I think is raising public concerns for the Canadian household sector in Canada. Our house prices, while the U.S. has corrected and pulled off its peak, our house prices have plodded on to ever higher heights, all-time record highs. And it doesn't matter how you measure this. Average resale prices, average new home prices. If we take the Canadian equivalent to the preferred U.S. measure, which is the S&P Case-Shiller repeat sales metric that tracks the same homes sold over time, and look at the Teranet gauge in Canada, that too is at an all-time record high. The U.S. experienced house price gains from 2000 to the 2006 peak equal to about 105%. In Canada, we're up about 100% over the course of the past full decade. Other than gold, I can't think of what better investment households have been able to make, particularly given the tax-sheltered nature of this investment over that span of time. Some analysts will say, don't worry about it, it's just one or two pockets in the country driving much of that. Don't buy that, that's nonsense. Over the course of the past decade, every single province across the country has experienced massive gains. We can't judge who has participated in this housing boom in the context of the last 6 to 12 months worth of house price data. Over the full decade, every province has experienced, most of these provinces have been up 80 to as much as 150 or 160% on house price gains over this full span of time. That's something that's run its course in our view and poised to pose downside risks to house prices. In fact, I don't rule out for one minute the possibility that we might be looking at a 10% pullback in average nationwide house prices as we go off over the next couple of years. We've also leveraged many of those gains in ways that Canadians have not done in past cycles. One measure is the debt-to-assets ratio. The United States tops the charts. Nobody takes on debt better than Americans. It's a national advantage, a great strength of theirs. In Canada, however, we're second in the G7 in terms of the amount of debt that we use to fund our asset book. This myth that we're somehow purer and manage ourselves much more conservatively than the United States is just that. I think it's in a significant part of a myth. On debt to income, we're at an all-time record high. That's not this chart, but I'll come to this in a moment. We sit at about 145% worth of after-tax income sitting in the form of debt. And that's an all-time record high in Canada, and not too far off the US picture, and among the highest in the world as well. Perhaps only Australia exceeds us, but well ahead of many of the European economies. As a share of after-tax incomes, Canadians are spending more to service their debts now than they've ever done in the past, despite low interest rates. Back in the early 1990s, we were paying less out of our incomes to service our debts, despite the fact that 90-day bills were trading in around the 12 to 15 percentage point range, because the Bank of Canada was hitting the brakes on interest rates to cool inflation risk. The reason why we were paying so much to service our debts is because households took advantage of that movement towards a low interest rate environment by taking on higher average size debts, and hence allocating more of their incomes towards the principal component to their debt payments. And you see that on this chart. The black line is showing the ramping up from the share of incomes going towards paying principal on their debts. That back in the early 1990s was about 5% of incomes, or it's about triple that right now. Just to give you an idea of the extent to which Canadians have really ramped up on their debt positions. The top red line is the aggregate share of incomes going towards all debt payments. In fact, not all debt payments. What we can't measure is some of the consumer lending products, because we just don't have the data for that on the principal side of the picture. So the true measure is actually higher than this. Now, I'll step back from the edge. It's a good thing we're on the ground floor, even though there are windows here. There's better news actually to end the presentation on. I do firmly believe that we're entering a much softer environment for our housing markets and the consumer streams. Even though we've gained over 425,000 jobs ever since August of 2009, when the job market expansion began in Canada, and that, by the way, would be comparable to a pace of growth in U.S. job markets equal to about 4.5 million jobs each in the U.S. economy, and they've come nothing shy of that. Although this morning's print was encouraging. They grew well above the consensus expectation for jobs, but they have a long, long way to go in terms of the path going forward. Against those risks, however, any tendency to draw further parallels back to the period of time we went through in the 1990s, I think, is dead on the wall. we have many more strengths that we can leverage in this current context that insulate ourselves against these household risks and that shift the opportunities, wisely so in my judgment, away from allocating so much excess capital towards housing markets and consumption and more towards funding businesses and bright ideas and capital spending and longer-term thinking in terms of the Canadian economy, as opposed to here today, gone tomorrow types of consumption that soaked up so much of the capital of the North American economic landscape. One of those strengths is you. You've managed your balance sheets far better than you've tended to do so in the longer term past. The red line here is showing the amount of debt that exists on Canadian non-financial corporate balance sheets relative to the amount of equity. It was out of control by the late 80s, early 1990s. You remember the Drexelberg, Lambert, Michael Milken days, the junk bond kings, the late 1980s. The debt in corporate capital structures was just frankly out of control. Over that span of time, they brought their debt-to-equity ratio down sharply for a lot of reasons. For one, lower inflation discourages so much debt in that context. For another, as interest rates have fallen, they've lessened the interest write-offs against taxes for a lot of businesses that also discourages debt relative to equity. At the same time, corporate income tax rates have dropped throughout this period of time. That also lessens the interest tax shield savings on corporate earnings from the write-off effect. And I think they've learned from the early 1990s that was a nasty period. Many of these companies were on the brink and or failed, so they've responded in lagged fashion by managing their finances much more conservatively than in the past. That gives them a tremendous strength. In fact, in a paper we published this week, one of the key areas of strength that we flagged was that corporate balance sheets in Canada are among the strongest anywhere in the world right now, judging by metrics like debt-to-equity, interest coverage, and comparable measures. Canada's public sector was in a mess in the 1990s. We learned. We pulled back from the brink. The mid-1990s was not kind to this country. The Wall Street Journal called us a banana republic. We don't like to be called banana republic. It hurts our national pride. The ratings agencies threatened downgrades. Our Prime Minister wasn't particularly capital markets savvy in the day. He dismissed capital markets critics as, quote, armchair observers who wouldn't know how to run a country. Didn't go over well in global capital markets. We learned from that and deleveraged long before much of the rest of the world ever set along that path. You hear all the headlines now about the huge fiscal problems facing the US economy and much of Europe. That was Canada mid-1990s. We pulled our debt to GDP ratios well off of those peaks. We reformed ourselves. That's one of the other reasons, along with corporate balance sheet strengths, why Canada outperformed and performed much better than the huge vicious downsides to house prices and jobs and other economic fundamentals in other countries. Another positive, despite the US having seen its home equity position vaporize, in Canada it's much, much stronger. This is the difference between the value of a house minus the debt owing on that house divided by the value of the house. So it's a percentage measure. What we have still invested in our homes is almost double the ratio that Americans have invested in their homes. And I think we may give up a little bit of that in the short term, but we'll still retain a strong advantage over Americans in that context. And the key here is because leverage doesn't operate in the Canadian economy anywhere near what it does in the US. Households may have leveraged themselves up comparably as in the States, but the key differences are that our banks are far stronger than they are in the States, far stronger capital ratio positions. This is why the World Economic Forum ranks Canadian banks tops in the world in terms of their resilience and stability compared to other banks elsewhere. It's why people like Paul Volcker, past chairman of the US Federal Reserve, continues to heap accolades on the banking sector in Canada. That strength is what enabled them, through their buffers and capital sources of strength, to continue lending throughout much of this crisis, or to not retreat in other categories of lending to anywhere near the same extent to which occurred elsewhere in the world. And lastly, Canadians have a huge cash buffer. It's not doing them any great favors right now because they're earning a big donut on it in this kind of environment, but it's a good credit quality insulating factor. They stand on about $1 trillion worth of idle cash sitting on household balance sheets right now in the aggregate Canadian economy. That too is at an all-time record high, and they've continually ramped it up during the period of, in frankness, in all fairness to them, pronounced equity market volatility throughout much of the past decade. That too is a good supporting factor to the outlook for consumption, along with the jobs picture in the near term, at least carving out bottoms, but I think most of that is probably going to get redeployed in the longer term towards some better investments. I'll end on a slide. These slides are available at my request, if you would like, with some comments on the health of Canadian mortgage markets, and this is the most important point that one can make, going back to the negative comments I was making about the risks facing our household sector and housing markets. We do not run the same mortgage market in Canada. We check your incomes. We actually make sure that you have the house, the papers that you are claiming to purchase. We don't engage in things like liar loans or ninja loans. No income, no job, no assets. Here, the keys to your brand new home, like they did in California. We don't securitize or parcel off the loans and sell them off into the blind market as much as they did in the United States, to anywhere near the same extent. Much more of our bank mortgage book is in Canada funded by stable deposits as opposed to the revolving door type of funding that characterized Wall Street, where they originated the loans and then sold them off as quickly as they could in a elaborate game of musical chairs, where you don't want to be the last one looking for a chair. In that context, this whole long list of competitive strengths facing our mortgage market is what insulates us against any more material downsides to our housing markets. Closing, I'll leave you with the concluding comment. The Bank of Canada, we think, is on hold until next fall. By the time they start to raise interest rates, we think that they will do so at a modest pace. This is a generational turning environment of prolonged lows in interest rates for a multi-year period of time that I think we're looking at. However, get used to a very, very strong Canadian dollar. Because of the problems affecting the U.S. fiscal landscape and the deteriorating appetite for risk in world markets that is shifting towards emerging markets relative to the United States, I think this is going to create a prolonged period of time in which appetite for holding U.S. dollars is going to be diminished. And that's probably going to put upside pressure upon our Canadian dollar. Don't roll out for one minute. In our forecasts, in fact, that the Canadian dollar goes up another nickel again. Beyond parity against the US dollar as we go off into the end of next year. This is an environment in which we have the strengths to leverage balance sheets, low interest rates, cash positions, to invest, to become more productive and efficient in the context of a long period of time in which the Canadian dollar is going to be at elevated levels against the US dollar, just by virtue of the problems they're going to be going through in the US economy for a prolonged period of time. Thank you very much for your attention.